Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning and we are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleagues Surabhi and Nigel. Guys, hi. Good morning.
Morning.
You know, the motto of markets is expect the unexpected, right? And I think that is what has hit us.
Prashant, I was thinking about what you were saying, right? That we go looking at the markets in the evening and it's one color. This time it wasn't even evening. I was looking at things till about 12:30 last night and you wake up to an entirely different world. That's, I guess, today's market for you.
Well, you know, just talking about the day, it's 23rd of March, right? 3 years ago on 23rd of March, COVID hit, everything was locked down.
Yeah, lower circuit.
You know, no, we ended at around 7,600 odd.
Yeah.
We're at around 17,200 odd. So, and besides the markets, you know, I was coming this morning and I think a lot of schools are reopening. Right. It was heartening to see, you know, the hustle and bustle. I recall 3 years ago, I was one of the only persons who came to work on that day. And in fact, there was absolutely no one.
Yeah, I remember how the office used to feel at that time.
There was no one on the roads as well, Surabhi.
Yeah.
You know, it was one. So we've come a long way. And obviously, markets will be center stage. We'll talk about Powell, talk about Yellen. But I just thought, you know, 23rd of March, 3 years ago, things were very, very different. So.
And you know, I'm glad you mentioned that, Nigel, because it just puts things in perspective. While we'll, of course, talk about how markets are disappointed in 25 basis points or whatever, but compared to that day, I think we're so much better off, personally, health-wise. So, well, let's count our blessings as well, I guess, Prashant.
Absolutely. You know, so let's just quickly tell our viewers what happened, right? I mean, there's a graph which we want to put out, and I think that explains everything you need to know about yesterday's overnight market action. Look at this. This is what happened to the S&P 500. You know, you can see the Fed decision which came through. Markets were okay. They went up a little bit, came off a little bit. Then the Powell press conference began. There was a bit of a dip. The market kind of started going up a little bit again. And then out of the blue, you had the Treasury Secretary Yellen who came in and started speaking and was one way down, the market ending at the low point of the day. It was a late day sell-off. So the graph, I mean, they say a picture speaks 1,000 words, and it does. But let's just quickly explain this a little bit more in terms of what you need to know. So late day sell-off, and the indices ended the low point of the day. The S&P, the Nasdaq, both down about 1.6, 1.7%. The Fed delivered a 25 basis point hike, but it was a dovish hike. And the reason is very simple. You know, there was the median dot for 2023 was unchanged, which basically means that there is only one more rate hike. And the language was changed to give more optionality to the Fed to pause and maybe do perhaps effect a cut, etc., sometime later this year as well. So this is why, you know, the hike came through as expected. And we've been making this point that it's highly unlikely that they won't hike. I mean, there was a hike, but there was a statement which I think was dovish. But I think what was out of syllabus in more ways than one was the Treasury Secretary, Janet Yellen, who came in and her comments hurt bank stocks quite badly. I mean, she basically ruled out providing any blanket deposit insurance. So, you know, this expectation had been building up that the US will backstop all deposits. Actually, just an hour before these comments from the Treasury Secretary, the Fed Chair Powell himself, in a pointed question in the press conference, had said that it was a terse reply, but it said that depositors should assume their deposits are safe. An hour later, you have the Treasury Secretary who's saying that they're not considering a blanket sort of insurance for everything. The main concern for bank stocks has been the outflow of deposits out of regional banks into stronger, larger banks. And the fear is that that will accelerate. Post the comments, I mean, the real sell-off began. The S&P Regional Banking Index was down 5.5%. You know, this is the crux of the problem, and this kind of has been driving sort of other indices as well. It took the overall market lower as well. By the way, you know, the banking issues are center stage. Just to complete that loop, Powell in his press conference said that if it had not been for the stress emerging from the banking issues, our forecast perhaps for the interest rate trajectory would have showed, I mean, he was speculating, but he said perhaps it would have shown another 1 or 2 additional 25 basis point hikes. So it probably would have been 5.75, not 5.25, as the median dot now shows, which basically means only one more rate hike. So this is, I mean, you know, stuff coming out of the US. Now let's come to the market here, which was starting to look a little better this week. Yesterday, of course, was disappointing because we could not build on the early gains. The market sold off, did nothing. But the call yesterday, in a way, was that, you don't know what's going to come out later. So if you're trading very near term, it's better to kind of hang back and see which way things go. And we now know that we've got a big red day as far as the US is concerned. Yesterday's high at 17,207 and the 20-day moving average at 17,328. Both are very close by. I mean, in case you start to get some bounces, these are the levels that the market needs to take out. Expect there to be selling pressure around these levels. If we do get to those levels, SGX, at least I checked this morning, was indicating a lower start. On the way down, the low of 16,828 should be protected on the Nifty if, further downsides have to be ruled out. It's 16,850 basically. Just take that as the level. We have two bounces off those levels, so that's the main level in the near term to defend. For the Bank Nifty, the 20-day moving average comes in at 40,175. Again, these are very near-term level. And the 50% retracement of the recent decline is 40,269. 40,175 and 40,269. Expect the market to face selling pressure, resistance around these levels. On the downside, the near-term low of 38,941 is the one which needs to be protected, which needs to be held on to for the market to have hope. It's a bit of a confused, muddled kind of picture, especially after the commentary from Treasury Secretary Yellen. So I think we will live off cues out of the US at this point in time, with, of course, the basic background being that the market has come off quite a bit. We've come down to 17,000 levels. Positioning is extremely bad. Nareen pointed to that, expecting a tactical bounce, and we will get that. But is today going to be that day exactly? I think, with the cues that we have out of the US, perhaps maybe hold back a little bit, see what the market wants to tell you after the first 1 hour of trading, once the market settles down, and let the market tell you which way it wants to really head. SGX is flat, down about 30 points or so. Surabhi.
Yes, Prashant, I guess you've wrapped up most of the important bits. I mean, the only thing that I'll add is that the market here, almost as if it anticipated that there's going to be an anti-climax, because at 12:30 it looked all good, yeah. And then the Yellen comment kind of came in. So I think the one thing that's going for our market is that we never really, rallied much going into this event in any case. Yesterday was a nothing sort of a day. So will we really unwind to the extent that we saw that fall on Wall Street? That's one point. I think the cues have been put on the table. I just want to mention the specific phrases that will probably be a part of sort of chatter today. So what made it dovish? Why was the market happy till about 12:30 IST, our time? That's because the phrase ongoing increases to describe how they will get to their inflation target, that was replaced by some additional policy firming. So the moment ongoing increases was replaced by this word some, the market thought, okay, this is the Fed climbing down, saying only maybe another 1 or 2 rate hikes at max. And that's when the rally actually started. The Fed did reiterate several times its commitment to come back to 2% inflation. It's, a larger objective. To that extent, there was some underlying hawkishness, if you could call it, but then it was a 25 basis points rate hike with a promise of stepping in as needed. On the banking crisis, I just want to say what the FOMC said, that things are still uncertain. That was the takeaway from the statement. Powell went on to say that recent developments are likely to result in tighter credit conditions for households, businesses, and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. Not once but twice, the point that Prashant made, not once but twice the Fed chair mentioned that banking, deposits, and savings are safe. That seemed to be giving an indication that perhaps they're looking at a wider deposit insurance, or basically a big backstop, and that's exactly what Yellen completely dismissed. Pull up Janet Yellen's statement, and she went on to say, I have not considered or discussed anything having to do with blanket insurance or guarantees of all deposits. So that's where everything changed. The big question, Nigel, I think is going to be now, has this disappointment been priced in one day, get back to life and simply move on? Because this was market's anticipation, right? They never said that they'll do it for system-wide all deposits, but the market wanted to believe that. She's gone ahead and said, no, we're not considering it right now. So I don't know. I mean, can you move on after a one-day disappointment? Perhaps, yes. I think the bigger question is going to be what banks are doing internationally and what bank stocks are doing here in India. Yeah. I didn't mention the FII-DI numbers, actually very minuscule sort of. The net number is not much. There's a 60 crore FII buy figure that came in. But I think for me, again, I go back to watching the bank stocks. Prashant mentioned some levels as well, because the selling there is relentless. Until that doesn't stop, there's very little to counter. There was Reliance the other day, but otherwise, there are very few counterweights in the market.
Well, before we get to Yellen as well as Powell, sometimes adversity provides the best opportunity. And since today is March 23rd, and just want to recall what was the Nifty level 3 years ago and what it is currently.
Yeah.
Sometimes, it does. And with regard to investing, it perfectly played out. At least if you just backtrack out there. But getting to the trade setup, well, we got a Fed rate hike on expected lines. Yellen's comments, however, have spooked the street. And also some commentary coming out from some of those banks out there, PacWest case in point. They're talking about deposits coming out there. So just looking at some commentary that we got overnight. And that's a smaller bank. It was down close to around 20% odd. So that's giving you a bit of a jitter with regard to the global-facing banking names. But since today is weekly expiry, let's focus on the positioning. And the positioning is such that 17,000 to 17,050 will hold out. The dollar index as well has cooled to around 102.3, which is good news, which is good news from a bullish perspective. What did the FIs do on the index futures? Not too much yesterday. They didn't add too much, and they continue to remain net short, with short positioning at around 92%. On the index option side, well, they wrote close to around 19,000 puts, and that's giving you some hope that maybe the low levels will hold out. Let's pull up the Nifty, the most active strike yesterday on the put side, the 17,150 put. That did see some writing, added close to around 20 lakh shares. Now that's giving you hope that maybe that 17,050 odd level should hold out. On the Nifty Bank as well, you had the 40,000 put that was fairly active for a Nifty Bank strike. And out there as well, it added close to around 15 lakh shares. Which brings us to the levels. Support, you want to hold that 17,000, 17,050 odd mark on the Nifty. That's the crucial support. Yes, the 16,800 odd mark, that's the level that you would like to hold out. But for the day, you want to hold that level. We're not talking about upside levels, but if you're talking about upside, then resistance comes in at around 17,280. But the Nifty Bank, that is likely to pull back a little bit more severe to kickstart trade. The 200 DMA is close to around 39,700. You don't want the Nifty Bank to break that 39,500 odd mark on a closing basis. You have resistance coming in at around the 20 DMA. So the SGX Nifty pulls back. But since it's weekly expiry, maybe in fact that 17,050 odd level holds out today. And if that is the case and we don't get any incremental negative news coming in from the globe, maybe that short covering bounce still is on the cards. So let's see how this plays out.
Okay, all right. Well, let's get started then. With the equity call of the morning, and this is coming from Eric Fishwick of CLSA, who says the Fed has left its rates guidance as it was in December, and this means a terminal Fed funds rate of 5.25%. However, he adds the FOMC guidance is still against any cuts this year, and rate expectations are too low. He says their central case now shifts to one further rate increase, terminal rate of 5.25%. And this may occur at any of the next 3 FOMC meetings, May, June or July. Eric says if it has not happened by July, it will not happen. However, he does not expect any cuts in Fed funds rate until around the middle of 2024. He adds that the second half of 24 can see a modest easing, but no more.
Well, let's get you some money market views now. Kunal Sudhani of Shinhan Bank says the FOMC raised key rate by 25 basis points as expected, but was considered as a dovish hike. He says the dollar index moved lower towards the 102.5 levels. He adds U.S. Treasury Secretary Yellen's comments on deposit insurance favored some U.S. dollar rebound. He says European Central Bank seems to be more hawkish as compared to the Fed. Kunal adds the Bank of England is expected to hike by 25 basis points, while the Swiss National Bank by 50 basis points today. For the dollar INR positionally for March, he says 81.80 to a dollar acts as a support, while 82.75 to a dollar is a resistance.
And on bonds, Parul Mittal Sinha of Standard Chartered says global markets remain volatile as monetary tightening impacting financial market stability as banks begin to show stress. She says markets have readjusted pricing of the extent of tightening in this uncertain backdrop, and adds that in India, though current inflation is above 6%, expectations of declining forward inflation do not warrant further RBI tightening in her view, especially given the challenging global backdrop. She expects the 10-year benchmark bond yield to trade in a range of 7.3 to 7.45 for the near term.
Well, we're tracking the global cues as well as we've given you market setup, but we'll be tracking a lot of stocks as well for you today, and we'll get to that in just a bit in our special Top 10 segment, where we're looking at Reliance Industries, Hero MotoCorp, Coromandel, Shali Hotels, Nazara Technologies, Max Financial, GR Infra, NBCC, as well as HG Infra. So a lot of stocks that could react to positive news flow, while on the flip side, HAL will open up in the red owing to that OFS that was announced late last evening.
All right. Stocks, lots of stocks to watch and lots of corporate developments, which we will highlight in a bit from now. But let's stay with the global stuff. Robert Sorkin is global economist at Citi, and Ed Yardeni is president at Yardeni Research. Both are joining us right now to take some questions. Great to have both of you with us here. Thanks very much for your time. Ed, if I can start by asking you what you made of, Secretary Yellen's comments, which kind of seemed to be in contrast to what we heard from Powell at the press conference. Powell basically said that depositors should assume that their deposits are safe. And here she kind of ruled out any blanket insurance for all deposits. Which one is it?
That's a good question. I mean, it really makes your head spin to see the kind of talk that we had today and its impact on the marketplace. I think Janet Yellen misspoke. I think that Powell's position is probably the one that's going to prevail here. And the idea is that yes, the government, the Treasury, that is, and the Fed are not in a position to insure deposits, but they are in a position to guarantee that the banks themselves will remain safe. And so I think that's the fallback position that Yellen's going to have to get back to really quickly here.
Robert, so what's the takeaway? The market up till the Treasury Secretary spoke, seemed to be of the view that we'll probably get another % rate hike, and that's it from there. Though the FOMC statement itself is pointing to the uncertainties of the banking developments on the larger economy. So how should we read and interpret the next couple of months with respect to policy tightening?
That's a great question, and thanks so much for having me. And I think going into this meeting, it was a very tricky meeting for the Fed. And I think the way that they handled it really highlights the dual objectives that they're trying to balance and the uncertainty of the situation. So the Fed is trying to balance its fight against inflation, at the same time maintaining financial stability. And right now where we are, we don't know how much of the banking stresses that we've seen are going to prove more long-lasting, and we don't know how much they're going to move into the real economy. And so the tone of the Fed very much reflected that. They did still hike 25 basis points, but I think the key to that communication is that they held the dot plot at just one more hike, which was the same as it was in the prior meeting, and they really highlighted and softened up the language about what they're going to do next and really leaving a lot of optionality on the table. So it depends really what you think the Fed is going to do next. It depends on how much you think these banking stresses are going to tighten financial conditions, how much these things are going to be destabilizing, and how much they're going to play into the real economy. Our view is that these stresses will largely subside over the next several weeks. And that's going to allow the Fed to pivot back to focusing on inflation, which still remains fairly intense and fairly high. So we haven't changed our Fed call. We think they're still going to go to 5.5 to 5.75. I know that's on the more hawkish side, but it's really based on this view that we think that these stresses are probably going to subside over the next several weeks, and it's going to focus again back on inflation. But I think the Fed meeting today, the real takeaway is this is a very uncertain situation, and the Fed's very open to seeing how the data play out, and then they'll move based on those factors.
All right, noted that, Robert. But Ms. Yardeni, coming back to you then, what are you factoring in terms of how many more rate hikes we see? Is it just 25 basis points and then we're done? Or do you believe you have a couple of more in the offing, provided we don't get any more banking shocks that come out from the United States?
Well, I think that the Federal Reserve may very well go one more time by 25 basis points, though I think the fact that we now have this banking crisis and that the Fed understands that the banking crisis is equivalent to some increase in the Fed funds rate. As you mentioned, Powell suggested it might be equivalent to 50 basis points. I think it could be equivalent to 100 basis points. Nobody really knows. As Robert said, there's a lot of uncertainty here about how it plays out. But I think first and foremost, the Fed and the Treasury are going to have to get their act together and make sure that they're using the exact same language to describe the importance of keeping the banks safe. And I think if they can undo the damage from what Yellen managed to do today, then I think the banking crisis will be equivalent more to 50 than 100 basis points. And it probably will mean that the Fed doesn't really have to go again.
Ed, what does it mean for global markets, equity markets in particular, this kind of environment, in your view?
Well, I think that we've seen the dollar weaken here on the perception that the Fed is getting close to done. The ECB may still have further to go because they lag behind the Fed. And so a weaker dollar, generally speaking, tends to be good for global alternative markets, whether it be emerging markets or European markets. But of course, European markets have lots of their own problems, and the ECB is still talking rather aggressively about fighting inflation. So I don't know that it radically changes the outlook for investing on a global basis. I still think, you have to look for opportunities around the world. The U.S. isn't particularly cheap, but then again, some of the cheap markets are cheap for a reason.
Got that. Robert, just another question. Markets have been whipsawed, and even some of these banking issues are a result of the manner in which rates are moving, right? I keep going back to an analogy of a slightly reckless driver where you are, hiking, and then suddenly there's talk of cutting. I mean, there are a lot of expectations on cuts as well as we get into 24, right? So your thoughts on how this will play out, and whether just this forward and backward momentum on interest rates in such a large market, whether that could lead to further complicated consequences, whether it's economy or whether it's banking?
That's a great point to make. And, just to highlight the uncertainty again of the situation, I mean, the moves that we've seen since these banking stresses have emerged in markets have been huge. And at times you see, Treasury yields move up significantly. You've seen them move down significantly. You've seen stress in a lot of different areas. I really think that's the market trying to figure out exactly how deep and how far these stresses go, and that's probably going to continue for some period of time into the spring, because you're likely to get more episodes of banking stress at certain players in the U.S. You're going to get market fears about banks in Europe. They'll probably flare up at different times. So I think we're in for a period of volatility and uncertainty, and certainly that doesn't help from an investing standpoint or from a stability standpoint. And I completely agree with Ed's point that I think that part of the reason that we think these stresses are going to subside over the coming weeks is that, in this episode, policymakers have moved swiftly, they've moved powerfully, they've kind of learned the lessons from 2008, that you shouldn't let these issues fester, and that the response has been fairly rapid and impressive. On top of that, you're dealing with banking systems that are well capitalized and well regulated overall. So I completely agree that in order to get some of these market swings and to calm down and maybe to get the system stabilized, we need sort of a coherent, continued policy response to these issues. And then again, for us, we think once you get to that place and that these issues move more towards the back burner, you're going to get back to focusing again on the real side of the economy, and inflation, which still remains intense, and that likely means some more policy tightening. But no doubt that this will be a fairly volatile period for at least several more weeks.
Okay, so I guess strap up. The roller coaster continues to move on. Thank you very much, gentlemen. Great speaking with you this morning, and thank you for the perspective on all the announcements that we've heard overnight. We will take a break, but before we do that, President Murmu conferred the Padma Awards last evening. Top industrialist Kumar Mangalam Birla was among the Padma Bhushan awardees. The Padma Shri was conferred upon one of the most loved voices in the market, ace investor Rakesh Jhunjhunwala, posthumously. We'll leave you with glimpses from the ceremony. Welcome back. Some of the Asian markets are actually holding up pretty okay, and the SGX is now trying to move back to the flat line. So pretty interesting. Let's see if we actually manage to get a decent opening. Quickly taking it down to our stock list of the morning. Our team is standing by, and we are kicking it off with the HAL. Guys, good morning. Vivek, you go first. So we have an OFS coming.
Well, absolutely right. So government divestment, they've chosen the OFS route, the offer for sale route. The base size for this particular OFS is 1.75% with an additional upsize option of the same quantity. Now, the floor price for this particular OFS is at 2,450 rupees a share, almost 6.6% discount to the last traded price, mainly mandated by the fact that the government has to bring down its shareholding to meet the minimum public shareholding norms. Now, there's an interesting development. Morgan Stanley believes that this is less than what the market was anticipating in terms of a 5% OFS. And in fact, what they're saying is that this removes an overhang as far as further stake sale from the government is concerned. In fact, they continue to remain overweight and would look to any weakness to add to their positions.
Okay, all right. Thanks a lot for that, Vivek. The stock actually was a little bit nervous in the last couple of days, so let's see how that one reacts. Mangalam joins us to tell us about Reliance Industries. Morning, Mangalam.
Good morning. So Reliance's consumer arm has gone ahead and launched some new products. This is for home and personal care range under some new brands. For soaps, they've launched 3 new brands called Glimmer, Get Real and Puric. They have dishwash bars liquid as well as Home Guard brand for floor cleaners, etc. But more importantly, they also launched Enzo as a brand for detergent powder, liquid and bars. While this is a positive for Reliance, they've been talking about their foray and growth in the FMCG business. I'll be more interested in tracking the impact that it could have on listed competitive players as well, because we've seen Reliance disrupt the telecom place. Let's see whether in the FMCG space there could be some nerves around these manufacturers too.
All right, Mangalam, thanks very much for that. Now, Sonal is standing by with more stocks with news flow. Sonal, hi, morning.
Good morning, Prashant. Let me start with Hero Moto. There has been a price hike that the company has undertaken of around 2% on select motorcycles and scooters. This is with effect from 1st April 2023. Coromandel International, it's an agrochemical company or a fertilizer company, so to say, but they have now forayed into specialty and industrial chemicals now, and they will be investing around 1,000 crore rupees over the next 2 years on this one. Chalet Hotels, they have made an acquisition, approved share purchase of 100% in Sonmil Industries, that is for 75 crore rupees, and Duke's Retreat as well, 82.3% stake there for a sum of 82 crore rupees. Nazara Technology, they've gone ahead and made one more acquisition. A subsidiary will acquire Pro Football Network, which is number 3 NFL publisher in the USA. It is an all-cash transaction for 73.3% stake. The cost is around 16 crore rupees.
Okay, got that. Sonal, we'll watch out for the list. Vivek, you have some more names with you?
Well, that's right. A few stocks to keep on your radar on the back of news flow. Some block deals yesterday. So Max Financial yesterday, approximately 0.5% of equity changed hands. One of the promoter entities was the seller, and New York Life Insurance actually upped their stake in the company. Whole host of order wins in the infra space. So GR Infra, the company in a joint venture with Patel Engineering has emerged as the lowest bidder, and this is for a tender invited by NHPC. Project cost of close to 3,630 crore rupees. Timeline for the project is 86 months. NBCC, some green expected on the stock. The company has got a letter of award for construction of a medical college in Maharashtra, project on an EPC basis, and the value of the project is over 625 crore rupees. Lastly, HG Infra, another order win for the company, has been declared as the lowest bidder for an NHAI project. Cost of this particular project at 925 crores. Construction period of close to 730 days. This for a 6-lane highway construction in the state of Jharkhand.
Okay, all right. Thanks a lot for that, Vivek. Well, let's do a quick recap then of all the top stocks that we just discussed. Stocks with positive news flow include Reliance Industries, Hero Moto Corp, Coromandel, Chalet Hotels, Nazara, Max Financial, GR Infra, NBCC, HG Infra. They'll all be reacting to positive news flow, while only HAL will open up in the red owing to that OFS. Well, that's about the equity markets, when Manisha Gupta joins us as well to run us through all the action from the commodity space. Morning, Manisha.
Nigel, thank you for that. Well, the 25 basis point rate hike was factored in, and we haven't seen a knee-jerk reaction come in for most commodities. The crude oil prices, I'll start with that, is holding around $76 per barrel. We've seen 4% of gains for crude prices in this week. The markets also are reacting to the U.S. inventory build-up on one side and the product inventory decline on the other side. So we are looking at status quo onto this one. The metal prices, in the meanwhile, definitely have seen a gain. So the gold prices gained 1% overnight, and they are trading another percentage higher in the Asian markets right now. It benefits from the U.S. Fed cautious stance, but the concerns about inflation also have supported buying. And then it has been the decline in dollar index as well, which is trading below 102. And that is the reason you've seen support for the industrial metals. So whether it's about copper, which is trading firm, aluminum, zinc, steel, all of them are trading on the higher side of their range. We have seen mining recession concerns on one side, and on the other side, the China on-ground demand really seems to be increasing because there is a premium on immediate deliveries vis-a-vis the forward month, and that tells you that the demand on ground right now, immediate demand, clearly has been on the supportive side.
All right, Manisha, thanks very much for that. It's good to get that sort of lowdown as far as the commodity space goes. We'll take a quick break here. Nishal Maheshwari of Centrum Broking will join in for some fundamental stock talk. We'll connect with the management of KEC International to talk about their new order win. Stay tuned. Both those conversations come up next.
Welcome back. You're with us on Bazaar Morning Call, and let's take the conversation forward now with Nishal Maheshwari, who's joining us. And we have a lot of fundamental stocks and themes to talk about. He's, of course, CEO Institutional Equities at Centrum. Nishal, good morning. Great to have you on the show as always. I straight away have one company in mind that we wanted to discuss with you, and that's Hindustan Aeronautics. A, because the stock's done so well. B, because, defense is such a buzzing space, so much order inflow. And C, we have an OFS. So what are your thoughts on this one, and how would you approach it, given that in a tough market, this is a stock that's rallied, 80-90% in the last 1 year?
Morning, Surbhi. I think, yes, the outlook on HAL remains to be pretty robust, basically, whether it is the order book, basically, which you see it, or the defense requirement for the country. And the third most important thing is basically that the government is looking to manufacture more and more products domestically rather than actually imported. So obviously, I think HAL is at the forefront, and I think at these valuations basically looks interesting. So I would recommend my investors to be participating in the OFS.
Okay, so that's thumbs up, and you're looking at participating in the OFS. Initial, just the other specific stock on which needed your views would be GAIL, I think, because a lot of chatter since yesterday. They've got that huge tariff hike. Not as much as what the company wanted, but it's a big hike nonetheless. What's your view?
So I think this was expected to happen. I think we are a bit disappointed, basically, that the hike is not as much as what market was expecting. So we are a bit disappointed there. I think the stock has reacted positively earlier. We continue to believe that it's a good bet at these prices, but I think the stock will react negatively today.
Nishal, the other one is Sobha Developers, which sold off some 13-14% yesterday. There were those some searches which were going on. The stock's basically back at February 2020 levels. The other Bangalore-based developers are all, nowhere close. They're all done far better. Any thoughts? Do you have this under active coverage?
Morning, Prashant. No, we do not have it under active coverage, but I think two things basically which are more or less defining for the whole industry based down south. So I think there is some disappointment as far as I think IT is concerned. IT is the major driver out there, and given that we are seeing some slowdown in IT basically across the world. So I think market was waiting for a cue basically, and maybe this is a trigger basically which is set off for people to take profits. Most of these stocks down south has done pretty well. So I think this is what I would see into it. There is going to be a slowdown, both IT as well as interest rates going up as far as the real estate is concerned.
Hi, Nishal. Good morning. What about the insurance companies? There was a root shock in the budget. But from there seems some bit of stability and some bit of buying as well. Your view on the insurance stocks?
So I think post the budget, basically, most of these stocks have corrected dramatically. They've come down almost 15-20%. So most of them, when we went back and looked at it, I think most of them were 8 to 10% kind of business coming from that particular segment. So I think the reaction was unwarranted. People are finding value basically at these prices. And that's why we are seeing some bottom fishing happening. In that sector, our top pick still remains to be SBI Insurance. I think that's our top pick basically in that. And we continue to recommend saying that you should be accumulating these stocks at these prices.
Okay, Nishchal, stay on. Now we will have more stocks and more of the market to discuss with you. But right now we have a management joining in. KEC International has bagged new orders worth about 1,500, just over 1,500 crore rupees from Power Grid. With this order win, the company's order inflow has reached an all-time high of 21,000 crore rupees. To discuss this, we have Vimal Kejriwal, MD and CEO at KEC International, joining in. Thanks very much, Mr. Kejriwal, for being with us. Could you just tell us now, with this order coming in from Power Grid, sort of what is the visibility on the execution? We're entering a brand new year, so your order book is, of course, very, very lofty. How do you see execution shaping up, and what's the revenue growth visibility for the next year, FY24?
So, morning, Surabhi. So these orders, typically, if you want to execution of these orders, these are all typically 15 months orders. So execution will start immediately in Q1. And almost the entire revenue should come in FY24. Overall, I think we have been talking about 20% growth for the current year, that's FY23, and a 15% plus for the next year, FY24.
Morning, Mr. Kejriwal. What about margins on this new order win?
Typically, again, it would be between 8 to 10%.
Okay, all right. And, you were telling us about your order inflows will comfortably exceed that guidance that you had given earlier, I think of around 21,000 odd. What do you end this year with in terms of order inflow?
So, Nigel, we have orders of 21,000 and plus, and we have around another 4,000 crores of L1. So, I do presume that, some part of that will get converted. So, we should end up probably with 22.5 or 23 or something like that, in that range.
Okay. All right. And also, I wanted to clarify, I recall you were telling us that the Afghanistan collections will come in by the end of this fiscal. I think it was 200 crores odd. Still on the cards?
So part of it has come in, and part of it we have just closed a settlement. I do hope that the money comes in before 31st March. If not, maybe a week or two beyond that. But since we have arrived at a settlement, I think we are on ballpark to get our 200 crores.
Okay, just to go back to, an idea about FY24, Mr. Kejriwal, obviously, power is a chunky segment, but you're also doing a lot of work on the water side. If you could give us a breakup, how much of that is contributing to the revenue pie, and what will the mix look like, let's say, in the next 12 odd months?
So, Surabhi, I don't have the exact revenue part of it, but broadly out of our order book of 31,000 crores, which we have today, roughly 15%, 4,800 or something is in the water sector. And those orders are typically, up to 24 months or so. Some of them had come early. So as a wild guess, I'll say probably 2,500 crores or so revenue should be there next year from the water segment.
Okay. And how do the margins compare with, the orders that you typically execute on the power side, water versus power?
So margins would be similar. However, the water orders have a much better cash flow. Since they are funded by the central government. What we are seeing is, you raise an invoice and within 10, 15 days, you get paid for it. So our net working capital on water is pretty decent, I'll say.
Very quickly, before we let you go on the Brazilian operations, you were guiding for PBT positive in the second quarter of this fiscal. Sticking to that, right, Mr. Kejriwal, because that's been a bit of a scratchy point for the markets.
So it's next fiscal, FY24. Yeah, hopefully we should be PBT positive. We are already, I think, operating positive this quarter. We should be operating for the next 2 quarters also. The problem is the interest rates there are still not coming down. So we are refinancing all the loans there. Yes. So if you are able to close them by Q1, the entire refinancing, then Q2 should be definitely be PBT positive. If not, Q3, but it would be a marginal negative if it is negative. I do hope that we can make it PBT positive in Q2.
Okay, good to hear your thoughts. Thanks so much, Mr. Kejriwal, to stop by and give us a quick insight into the company as well as FY24. Looks like it's shaping up quite well. Slip into a short break. On the other side, our technical experts, Mitesh and Sudarshan, will be waiting for us with technical trades.
Okay, welcome back. There's about 12 minutes to go for the pre-open session, and we'll see how things pan out. But for now, SGX is absolutely flat, 17,142. we're again in a bit of a headline trading kind of market, depending on what this one says or that one says, and eventually I think we'll get clarity maybe sometime before we do that. But Anuj is here in the studios to tell us what he's making of things. Anuj, hi, morning.
Morning, Prashant. Morning, Nigel Surbi. This is something which, we made a point yesterday that the option writers were saying that maybe the market could be preparing for an anticlimax. This is as big an anticlimax as it would be, considering we were all preparing for a big day. But the SGX Nifty is saying all of 25 points. No shocker from Fed, of course, 25 basis point rate hike as expected. And the market has been respecting the option writers zone, and the SGX Nifty indicating that we will not participate, at least for starters, in the decline. What happens after that? My sense is we will make a move, but let's see. Let's wait for that. 2 points. Indian IT, I think that will negotiate with more weakness because of what's happening with the BFSI space in the US. And if there has to be any rally, that has to be sponsored by the Bank Nifty, which has been the stronger of the two indices, at least over the last 3 or 4 days. Now, the market has some clarity on terminal rates, even though the fall happened because of what Yellen had to say. You all discussed that already, so I won't go any further on that. But there could be some pressure on IT. Now, as far as Nifty is concerned, today's weekly options expiry, so I give a lot of importance to the option writers zone, and that zone is 17,080 to 17,250. If this zone is taken out, expect a big move. But unlikely, that's my sense, at least in the first half. On the Bank Nifty, I think that range is slightly bigger because it's a bigger index, so 39,600 to 40,400. But it's tough to play this range. I mean, 800-point range, it's almost impossible to play. I think it's better to avoid Bank Nifty for the first half, but you could get a sharp 3 p.m. move today in the Bank Nifty. I think that's something that you could, you could play depending on which side it makes the move, of course. But prepare yourself for a bit of a volatile session, but within a range.
Okay, all right. Thanks a lot for that, Anuj. Well, let's get in our technical experts now. Mitesh as well as Sudarshan joining us this morning. Good morning, gentlemen. Sudarshan, what's your sense in terms of the Nifty? We're likely to pull back a little bit. How would you trade it?
Yeah, good morning. See, the Nifty has been moving in a narrow range for the last 2 days, and that tells us that a big explosive move is coming. Now, because the news event is behind us and there is no clarity on how markets will react, I would suggest that the first 1 hour of trading should be left alone. Don't do anything in the first 1 hour. If after 1 hour we see the Nifty above 17,100, then I think a trend day on the upside may be developing and we should go long into that market. Below 17,100, we should simply avoid the market. But wait for 1 hour initially.
Got that. Mitesh, good morning. What about you? What are you going to do?
Morning, Prashant. Last couple of days, we've maintained a positive bias and, have been looking at getting past 17,150, which has not happened on an hourly closing. But I think it could happen today. And then testing 17,260, 300 zones thereabouts. So I think there is still that setup which is mildly on the positive side. So we'll keep that stance. Only if we start trading below 17,060, 50 zone, then I think, we'll close out our long exposure. With stock specific basis also, we've been trading with more of long bias. So today I have a mix of buys and sell calls, but I think broadly slightly leaning towards the positive side. So we have more long positions eventually.
Okay, got that. Gentlemen, let's come to the stock ideas as well. Sudarshan, morning. What would you go with?
Hey, good morning. See, Hinlever is a buying opportunity. It had a big day, then a small correction, and again a narrow range yesterday. That tells that the message is that FMCG is now picking up after a long correction. So that's a buy, but all buying opportunities are positional. Don't bank on an intraday big rally, but for the next few days, something good could happen. Buy with a stop under 2,400. Manappuram is another positional buy. It had a big range, big decline, a decent rally, and is now on the verge of a breakout above a resistance level. Buy with a stop under 115. PVR is my only intraday short. Stop above 1570. And Dabur, and see this FMCG theme is now continuing. Dabur finally is a buying opportunity with a stop under 530.
Okay, and Mitesh, your calls?
Good morning. I have a mix of buys and sells today. AU Bank is something which is on the weaker side, so keep a stop at 590 here. Sell and look for targets of around 550 on the downside. And Coal India is the second sell call. Looks like a corrective pullback starting over here. So keep a stop at 217. Look for targets of 208. On the buying side is SRF. Here I recommend going long with a stop just below 2350 for a first target of 2450. And Dr. Reddy's, that's a buy as well. Keep a stop below 4440. Look for targets of around 4545.
All right, Mitesh and Sudarshan, great speaking with both of you gentlemen. Thank you very much. Very helpful to get those views right before market open. 6 minutes for the pre-open right now. We'll take a break. We'll come back with, of course, the rates. And Murtuza Arsiwala, Director, Kotak Institutional Equities, joins in to discuss the power sector, transmission specifically, and opportunities that he's seeing there. Stay tuned. Conversation coming up.